2022 is really a tough year for most investors, and many of us may still have concerns about the volatile market. To face the great uncertainties about economic growth, investment-grade corporate bonds are one of good choices to stay defensive. We are glad to have Hans from Voya joining us today, and he will share his view on topics related to investment-grade corporate bond. Hans is a vice president and client portfolio manager on a fixed income team at Voya Investment Management. He has been in the industry for over 14 years and is very familiar with fixed income market. Hi, Hans. Thank you for joining us today. We have some questions about USIG corporate bond and would like to seek for your advice. Okay, our first question is that we may see more rate hikes by Fed this year. Is it a good timing for investment of USIG corporate bond?
Yeah, so obviously we've seen the Fed continue to hike rates throughout the course of the year, and the expectation is that they'll clearly continue to move the Fed funds higher, another 150 plus basis points through the end of the year via a couple of hikes. And so obviously, if you look at the chart on the right, the move higher in rates has really driven the negative total returns across fixed income markets year to date. And so if you've seen a global move higher, as evidenced by the chart on the left, I should say, of the page, with the exception of Japan, as global central banks have continued to raise rates in order to tame inflation. And we expect the Fed to continue to hike through the year as inflation has remained stickier than everyone had hoped. And so once we see a sustained slowdown in inflation, we expect the Fed to pause and hold the policy rate as long as the U.S. labor market remains strong. We don't believe that the Fed will cut rates unless we see a significant deterioration in the U.S. labor market. And so as a result, we expect continued interest rate volatility in the near term. The chart on the right shows interest rate volatility as defined by the MOVE index in the green line, overlaid with investment-grade corporate bonds spreads in the yellow line. And so interest rate volatility has been a key driver of that move wider in spreads. As you can see, the two have been very highly correlated throughout the course of this year. And so as a result, we do expect spreads to remain volatile until we have further clarification of when the Fed will be able to pause its rate hiking cycle. On the flip side, we do think from a longer term standpoint, this is not a bad time to start looking into IG corporate bonds, just given the overall current yield levels that we've seen.
Okay, our next question is, what is Tim's view on the U.S. economy, and what is the implication for U.S. IG corporate bond?
Yeah, so the U.S. economy has been fairly resilient in the face of significant tightening of monetary policy. This is due to both the strength of the U.S. consumer, who continues to spend, the strength of the labor market, where we've seen unemployment rate continue to remain fairly resilient, as well as corporate credit fundamentals. With that said, we do expect the economy to continue to slow as the Fed continues to try to tame inflation in the U.S. However, and as a result, we do expect corporate fundamentals to continue to weaken. But I think it's important to really highlight they're weakening from a point of strength. If you look at the left-hand chart, EBITDA growth has slowed this year, but remains overall elevated as compared to the last 10 years or so. Additionally, companies have reduced leverage back to pre-pandemic levels, and debt growth has been very low, if not negative, as you can see in the middle chart. This has led to more upgrades than downgrades over the course of the last several quarters, as shown in the chart on the right. And so we do expect this trend to slowly begin to reverse. But if we flip to the next slide, cooling corporate fundamentals and higher rates will result in lower valuations. It's continued to happen over the course of the year. And as you can see on the left, profit margins are retreating from peak levels. On the right, we show the 10-year yield in yellow on an inverted scale, overlaid with PE ratios for the S&P 500 and the NASDAQ. And as you can see, that move higher in rates has also led to a repricing in valuations. And while we think we've seen a bulk of the move higher in rates, rates could still go modestly higher from where we are today. So this, coupled with slowing fundamentals, will continue to lead to some wider spreads in the near term, and Q3 earnings will be very important to watch.
投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书，投资人须知。